Welcome back to MyFinJourney. Today I'm joined by Ryan Zabrowski, Senior Portfolio Manager at Cryology, a Marine veteran, and author of Time Ahead, Investor's Guide to Prosperity and Impact. Ryan has read over 1,000 books on investing, managed millions in assets, and spent decades helping business owners, doctors, and executives protect and multiply their wealth. In this conversation, we'll decode what truly separates average investors from the wealthy, how the wealthy invest wisely in uncertain times, and how lessons of Warren Buffett and the Marine Corps can shape your financial future. Ryan, welcome to MyFinJourney.
Thank you so much for having me. I'm excited to be here.
No problem, Ryan. It's our pleasure. So Ryan, as we dive in, I really want to understand what led you to where you are today.
I think I have a knack for it. I think you're genetically predisposed to your profession. I went in the Marine Corps and they put me in charge of money, and I got out of the Marine Corps and I've basically been in charge of money my entire career. So it's always just come natural to me. And as a little kid, I was into it. My grandfather, my father really mentored me, and I'm fortunate to be the much youngest child. So I had older brothers and sisters that mentored me along the way. So something I've always just had a knack for is figuring out what price to pay.
I love that, Ryan. Help me understand from your perspective, do you think people are scared of money?
I think so. Yeah. I think intimidated for sure. And especially what's interesting is you would think the larger the dollars get, the more comfortable it would be. But actually, the human psyche is different, because the larger the dollars get, as people go from not having very much money to having a lot of money, what I've noticed is they tend to freeze because the dollars are so much larger. And the way that you can get around that psychology is you think in percentages. So if you think I'm going to take 5% of my money and make an investment into XYZ, well, the psychology of somebody with $10 million saying, well, I'm going to put 500,000 into XYZ, when you hear the number 500,000 versus 5%, it has a different proven emotional reaction. And this is behavioral finance, which is, the fastest growing part of my field.
That's really simple and powerful, Ryan. I think it's really simple because people don't really have the bandwidth or the perspective or the vantage point to be able to think like that. But I'm curious, Ryan, for you, did you study behavioral finance? Did it come up in books you read? How did you get to the point where you were? Because obviously you alluded to genetics and just having a natural disposition to being good at this. I studied genetics, so I have my own comments on that. But most people don't really value psychology until later in their career, in my opinion, unless they studied it. So I'm curious to kind of hear your perspective.
Well, I read all the books. I mean, I had this tremendous responsibility of taking care of people's life savings, and that was very motivating to read as many books as I can get my hands on. And I basically just slowed down when I was learning less and less and less and less, which with every book, and you'd have to read 100 pages to find a new idea. And that was something with my book that I was a challenge, that I wanted to write a fresh book that really hasn't been written before with Time Ahead. With behavioral finance, there's a lot of theories out there, but having the pleasure of working with investors for all these years, I actually see some of them in motion in real world conversations. Fear of missing out is a big thing, and we're seeing a lot of that today. And that's just a behavioral part of being an investor. And the best way to keep that in check is to have a mathematically based approach. So everything that we do is really algorithmically based, and that allows you as a portfolio manager to have kind of repeated success year after year after year, because your emotions are going to let you down, in investing. My mentor used to say markets are created to hurt the most amount of people. And it's actually an interesting saying. So, we want to be more aggressive when other people are unwilling, and we want to be cautious when other people are exuberant. Like Buffett says, be fearful when others are greedy and greedy when others are fearful. So we really take
Ryan,
that.
I feel like I feel like you said that a couple of things that are quite powerful. It's hard for me to just, wind back and go into them. But I think to start with, and maybe we'll do the first one last, right? You just quoted Warren Buffett. You quoted, something that a lot of people quote. Why do you think it is so difficult for people to be greedy when others are fearful, or fearful when others are greedy, when they have that conventional wisdom, when there's so many people out there citing it? Why do you feel like there's still potentially a disconnect where we have to approach things maybe more emotionally disconnected and maybe more numbers based?
People always think the grass is greener. It's part of our psychology that there's always something. But even if you show somebody performance that they're in the top 2%, say, human nature says, well, why are we not one? And that mentality has been part of the invisible hand that Adam Smith taught us about that progresses economies. So our desire to always improve our own utility and always kind of wanting more is human nature, and it works very well with innovation and progressing economies along. But in a portfolio, if you are late to the party, that is generally when losses come. To kind of put guardrails around that decision framework with mathematics is a way to prevent you from being overexposed when at the kind of peak of a bull market or when the party's about to end.
Ryan, I love not only how well read you are, but how you actually cite and allude to the books or the theories that you're citing. So Ryan, before I ask my next question, I just wanted to pause for a second and say, if you're listening to this episode and you're learning something new already, if you found a lot of value, please hit subscribe, hit the like button. It's free and it helps more people discover conversations like this. Ultimately, it helps you add value to your friends and your community. So Ryan, earlier on you mentioned that as you progressed reading and learning, you got to a point where you'd have to read 100 pages to learn something new. Ideally now, you just go to ChatGPT and it would just teach you something new. But if somebody was to look at your book, for example, what do you think the most salient points would be that most people don't know? And to kind of put it, even more bluntly, if you were talking to your brother-in-law or your sister-in-law and you just really wanted to tell them the truth about money and investing, what would you say?
Risk is not stagnant, and it is in nowhere in life. So if you walk down a flight of stairs on a sunny day and you walk down that exact same flight of stairs in a snowstorm, the risks are going to be materially different. Driving is the same way, athletic competition, corporate competition, investing. And you have to have a framework to measure that when you're kind of competing at the highest levels in investing. So in my book, the first part of the book teaches investors how to measure their environment and to understand an environment that has abundance of opportunity where you want to be more aggressive, and when the environment is ripe to have a material decline in asset values. So part of this is, in my field, it's called tactical allocation, where you want to be very, very intelligent with how much risk you're taking in the correct environment. And you see the most successful investors in history, when you look at why they had such success, is they were aggressive when there were bargains and people were afraid and the economy was starting to improve and the health of markets was starting to improve. They were more aggressive in that type of environment. When the probability of a decline, meaning that things are expensive and the market's unhealthy and the economy's rolling over and people are very greedy, they tend not to be overexposed in those environments. So that's a very material thing. Like, we all know in capitalism you want to own cash flow producing assets, right? So the key to being successful and to be, financially independent, like what I know you're passionate about, is we need to own assets that produce cash flow and that appreciate. But when you purchase those and the price that you pay for those substantially changes the outcomes and the risk associated with those assets. Like in a 401k plan, they would teach you like the risk is kind of the same. So if you buy a technology stock, it's always going to be riskier than a bond. That's what they teach you in formal education. But what Buffett taught us is he says, well, what's the price? So at some price, that bond actually is more risky than that technology stock at a different price. So you want to be able to own capital assets, but you want to be able to properly price those capital assets to make sure that you're paying the price that you're going to be very happy with, just not this year, 5, 10, 20 years from now.
Fine. In a market like 2025, or in however we would want to word it, in a theoretical, in the past, there have been markets. The market has been existing for years. There have been markets, bull and bear cycles.
Mm-hmm.
How would you approach investing in a bull market from your perspective, Ryan?
Well, it first of all is age-based and goal-based. So, as our financial planners, we talk to the clients about all their goals. But if their goals are generally long-term and growth-oriented, you want to own companies. My bias is I am a value investor, but I own companies that have bright futures and have sustainable competitive advantages. So I prefer not to own a company that's past was brighter than the future. I definitely want to own a company that the times ahead are going to be equal or better to the times before. Your traditional value investor, if you look at those portfolios quite often, you see a lot of old, stagnant, not growing, highly levered, lower margin type of businesses. And what I have a preference to own companies that are having sustainable growth, that have impressive gross margins, impressive operating margins, that do not have more than 8 times interest leverage. There's just these criteria that you look for that, in my opinion, improve the probability of having long-term financial success. You want to own the right type of companies that have the right type of businesses, and you want to make sure that those companies have attractive economics. So Buffett would say, fine business economics, meaning that they just, you look at these statements and they're highly profitable. You don't have to overpay for them. They're well run. And that would be the cornerstone of the formula and the well-worn path for so many investors that have succeeded in capitalism. So, I've looked at all different types of ways to make money in this business, and owning those cash flow producing assets that have sustainable long-term competitive advantages is the way that gives people the highest probability of achieving their financial goals. You just want to make sure that you really understand and don't overpay. And you hear a lot of people today saying things are abnormally expensive, and what they do is they look in the rearview mirror and they compare values today to values of yesteryear. And I would caution people against putting too much of your decision. You want to value a business based on the cash flow that it's going to produce in the future, not what other companies did in the 1950s, 50s, 60s. You constantly hear strategists saying, well, stocks are expensive today because of, and then they look in the rearview mirror and they pick a date. Or they say stocks are expensive today because of, and they point to another country's stock market. And the reality is that's, if you're buying a piece of real estate as an investment, you would not say, well, what was this real estate valued at in 1950 or 1980? How you would value that piece of real estate is how much cash flow, free cash flow, can this real estate asset produce for me in now and into the future, and what price do I have to pay to acquire that real estate? And that's how you should value stock markets too.
Very powerful, Ryan. And I want to pause to just reiterate something Ryan said at the beginning, that this is all, for education. This isn't, investment advice at all. It's just, food for thought. So Ryan, from your perspective, do you think that the same, the investor should have the same outlook in a bear market?
Well, how we're built is we have 130 factors that we look at that have a historical accuracy in asset price direction. Now, it's not like 100%, but the factors that we rely on are more right than they are wrong. And then when you look at a whole collection and you weight those factors, you can get an indication of the probability of a bear market. And how we are built is as that probability increases, we would automatically shift some of our risky assets to assets that have done well in a bear market, specifically gold, which just hit a high today, interestingly, market neutral strategies, managed futures, arbitrage strategies, and treasury bonds. So if we would start to see that you can't really explain values, it's very hard to find good investments, people are really exuberant, people are taking abnormal amounts of risk, the economy is starting to roll over a little bit, market's starting to get unhealthy, that's the type of environment where we'd want to batten down the hatches a little bit and increase our allocation to some of these investments that have done well historically in bear markets. And that's what I'm saying. If you can do that, you can add a lot of value from tactically allocating those assets.
And Ryan, before somebody works with you or somebody like you, what do you think the biggest mistakes people make when trying to build their wealth?
Yeah, great question. So without question, I've seen it repeated. People are afraid to take risks after they lost money, and people want to take more risks after other people have made money. Okay, so not necessarily they've made money, but after other people have made money, that's when they want to pile in. And it's a psychology, right? So we evolved as a species and we survived and in the group and or the village, or if you would say when we were going out west and there would be an external threat, we would circle the wagons, we would put the people that are able to bear arms on the perimeter and the people unable to bear arms like children and elderly, we would put them in the center. So we have been taught as a species that the most risk exists on the perimeter and the safest place is in the center. And in portfolio management, you can flip that around. So when you see portfolio management and you see so many people feeling safe in the center of the pack, meaning that there's millions and millions of people already investing in this type of investment, and they feel very safe because so many people are doing it. Well, that's historically when losses come, right? Because we're in a capital market. So a capital market requires new money to push up values. So if everybody's feeling has kind of a uniform outlook and they have a very exuberant outlook, they've already positioned their money for that outcome. So then where is the new capital going to come from to push up those values to create those future profits, right? So that's what we see is people feel very good at the top of bull markets, and that's when losses historically have a higher probability of coming. And then in bear markets, people generally have lost a lot of money. They're scared, they're worried, they're poorer than what they were previously, and they irrationally sell businesses that they were happy to own at 30-40% higher values. It's completely irrational. So that's what I see. I see it's human nature for, frankly, to buy high because the fear of missing out and sell low of the fear of losing more money. And actually, we're built to do the opposite of that. So our objective is to, when people are afraid and when people are worried about tariffs and things like that, or people are worried about Ukraine and Russian invasion, or people are worried about COVID and things like that, we are built to take advantage of those prices in those bear markets. You know, Buffett has last thing I'll say, Buffett has this analogy of a baseball analogy. And he said, imagine a baseball game, and this is perfect because the Yankees are playing tonight, but imagine a baseball game with no called third strikes. So you could sit there and you could watch pitch after pitch after pitch, and you could only swing when there's a fat pitch. Basically teaching people that it's okay to be patient. It's okay for other people to make money at something and you're not. But you want to make sure your entry point into an investment, you're going to be very happy with that entry point.
I found that answer very insightful, Ryan. And I guess my next question, is intended to be educational, not necessarily investment advice. If you were to meet a friend and you're talking to that friend and he's saying, hey, I'm buying VOO or an ETF that tracks the S&P 500 and I'm buying every day. I'm, market agnostic. I'm not focused on, timing the market. I'm focused on time in the market. I'm not really sure what's going on in the market. I don't track it. I make money outside of the market. And I don't care for a financial advisor or to work with an expert in the market. Help me understand, internally, if you were just processing this is a friend, maybe you wouldn't speak to him candidly. What are you thinking when you're observing that as somebody who's an expert in what they do? Do you think that that's the right approach, wrong approach? Is it gray area?
I think, in my book, I write a whole chapter called Resolving the Active-Passive Debate, right? So that strategy has fantastic attributes. The active strategy has fantastic attributes, and what I try to do is bring both of those positive attributes together in the portfolios I manage. So for your friend that wants to always be in the market, I think that's fantastic, and it's a lot better than not being in the market. Okay? Now, is that better than owning individual businesses that align with your ethics, that align with your expertise? I would make the argument that I would much rather be able to choose the businesses that I own than own all the 500 companies. There's things that those 500 companies do that don't agree with my worldview. And also there's this thing as you get wealthy called tax loss harvesting, where if you own those individual businesses, you can really use the tax code to your advantage. Where if you're in one index fund, you really give that opportunity up. Owning capital assets in capitalism is a great thing to do for your friend. But this is what I would encourage your friend to read history books, to understand what really can happen with markets, and to make sure that you don't want to be a time in the market, I'm committed to the United States stock market. You need to be able to do that through a 50% decline. And that's what we see. We see the psychology of investors change as they start to lose money. So it's easy to say, I'm a passive ETF investor when everything's going very well. But a lot of investors today haven't experienced a real bear market, especially the younger in generation hasn't really experienced a real bear market where in the Great Recession, multiple investors lost 70, 80% of their money. So it's good to say that you're a passive investor in time in the market, but you need to really, and I've had investors say that this was the right fit for them, and I agree with them. But what I tell them is to write themselves a note and to write themselves a letter and to put it into their safe at home. And when their portfolio is down 50% and every logical fiber in their body is telling them to sell and stop the pain, to read that letter to themselves, to encourage themselves to stay the course. Because there are a lot of financial advisors out there that do not add a lot of value. And this is what Vanguard was built on. Vanguard was built on, you don't need a financial advisor, put all your money in index funds. So this is old thinking. This is 40-year-old thinking, right? But what Vanguard did another study, but now Vanguard does offer help. Because what Vanguard witnessed is millions of investors making bad decisions at the wrong time, selling out at the bottom, getting overexposed at the top. So they actually did a real famous study that showed that a financial advisor, even a mediocre one, that just keeps you to your risk tolerance and is that voice of reason that says, I know it's terrible that you're losing money, or I know that even though you don't know anything about XYZ stock, you want to put in half your money into it. A voice of reason can really help somebody as an investor. So there's a couple sides to that active passive debate. What I will say is, you have to make a differentiation between the taxability of the account. So if it's an IRA, the opportunity cost of having index funds is lower than if you're in a taxable account. And depending on your tax bracket, that can make a big difference. So if you're an investor that's in the 37th percent tax bracket and you want to have all your money in index funds in a taxable account, there are definitely better alternatives out there for investors where you can take advantage of this thing called tax loss harvesting. And it's a simple.
So Ryan, even in this response, you kind of alluded to the research. If you look at the history, you alluded to, hey, maybe you don't want to tie all of your eggs to the U.S. basket. Maybe you want to be a little more diversified than just the US. So having read all these different books on investing and on mindset and on growth and having studied history, what do you think the single best lesson is that you've learned that's changed the way you manage money and the way that you think about personal financial independence?
As a professional portfolio manager, Buffett says you have to be comfortable with the booing, and it's a great analogy. He's the king of analogies. The greatest teachers of all times taught in analogies, and Buffett's one of them. And he would say that you have to be comfortable with the booing, where you get a lot of pressure from investors to do things that is not necessarily in their best interests, and you just have to be comfortable not trying to make everybody happy and just sticking to the mathematics, because the mathematics is unemotional. So I would say early in my career, I I really worried and I really wanted to make everybody happy. Now I want them to have a great experience working with our team, but my job is to compound their capital. And I really just want to be a good steward of their hard-earned life savings.
I appreciate that, Ryan. So kind of diving a bit deeper when you talk about being a steward of people's capital, do you think it's possible for the average person to become wealthy through investing, or do you feel like that window and that time has passed?
Absolutely. Absolutely. You see it every day. It's not easy. It's not, if there was a immigrant that came to this country, 100% I can make them wealthy. Percent. If they have, if they have a fire in the belly and a good work ethic, you're not, you can get lucky by getting wealthy, but getting wealthy slow is a lot more fun than getting wealthy quick, frankly. So yes, if I had a 18-year-old immigrant that had little to no education, yes, absolutely, we can make him a millionaire or she a
I love it.
millionaire.
I love it,
But
Ryan.
it's hard,
And again, this is
hard.
just educational. It's not, financial advice or anything. But walk us through that. If he's 18, if he's 25, if he's 35, what do you think that path looks like? He has a college degree, he doesn't have a college degree. What do you feel like that path and that process looks like to make them have, let's say, like a $5 million net worth?
Well, it starts out with two jobs. People don't like hearing that. They want work-life balance, but I grew up in the Wall Street world and there was no work-life balance. And you talk to any person that is self-made, work-life balance is something that's a new concept. That was something that we didn't even understand when I was younger. So somebody that was determined to a lifestyle for themselves or their families, starting out with two jobs, being very financially disciplined, always packing a lunch, simple things like that, living a very underwhelming lifestyle and working extremely hard and starting to get that that extra capital working for you is critical. And the best place that somebody can start to do that is in the lowest end of the real estate market. So, you know, anybody that has a good employment history and has a good credit history, the miracle of the United States is that person can get a loan to get a very cheap house. Not a house necessarily that you'd want to live in, not necessarily a house that you'd want to have on your block, but you can lever up, use the bank's money, buy a piece of property, and start to parlay that into other properties, and then you want to use that capital, and then use that capital to buy individual companies. Now, most Americans start on third base. We don't start on in the beginning, so we can just start saving money in a 401k plan and maxing out our 401k and taking advantage of all of the opportunities. You just have to, obviously, the younger you can start it, the better that compound interest happens. And, for those young people, they have to prioritize long-term wealth over short-term lifestyle. And that's just the reality. If you make whatever money you make, you want to try to max out your 401k. And if you can put the most amount of money you possibly can in your 401k, and you just try to get by on the rest of the money, that's a very good place to start with becoming extraordinarily wealthy in my opinion, the greatest country of all time.
I love that, Ryan, and I would second that the US is the greatest country in the world and of all time. So I guess to kind of summarize this, Ryan, you're saying, hey, invest in cash flowing assets. If you're starting from scratch, get a second job because you need to figure out how to make money. Make some money, put it in real estate. That's going to be the lowest barrier to enter. And with leverage, you can scale up quick. And then maybe go out and buy value cash flowing businesses. Would that be like an accurate summary?
Absolutely. And, now information is so readily available, with podcasts like yours that are educating the public. Somebody can be sitting there remodeling a house and sitting there and listening to a podcast and growing their mind and growing their wallet at the same time. What you and your colleagues are doing is just amazing for the youth of this country. I literally had a $200 car. I used to drive at my lunch hour and eat peanut butter and jelly sandwiches in front of Bill Gates's house in Del Mar, California, and I would read books on like the magic of thinking big. So young people have to invest in their own education as well. Or you have a mentor that has been there, done that, but those are hard to find. There's several great mentors out there on YouTube that people can really just go and get educated. But when I was young and starting out, I just devoured books on how to be successful in life and how to be successful in business and how to be wealthy.
Out of curiosity, Ryan, of all those books that you read, did you reach out to any of the authors?
It's a good question. I have occasionally. I've never received like a comeback, but I should probably do that now that in the LinkedIn world, where it's so much easier to connect with a colleague as opposed to, sending an email or sending a letter or something like that. It seems to be hard to get to the source. I did send Buffett a copy of my book, and I'm still waiting. I'm still waiting on a response, but
Okay, so we'll pray that response comes soon.
I'm
So
not holding my breath.
with respect to Buffett, obviously we've talked about him a decent amount. We've talked about the idea of owning sustainable business, high quality businesses. How do you feel like an investor spots one?
A
Especially if
high
they've
quality
never,
business.
yeah, especially if they've never done one,
Oh,
invested
this
in
is
a
the
business in
coolest
the
thing
past.
about Buffett. He was so generous. So if I would tell people to read one thing, read his shareholder letters. He speaks so candidly. He just educates people. You get a front row seat on what it's like to be a capitalist, and he writes 30 pages approximately every year that is like the goat of investing, teaching you how to do it.
So I assume you read those every year. Is that a fair assumption?
But yeah, I've read them many times.
If
Yeah.
you look at it today from today's lens of like lead magnets, would you say that he was probably the first one to put out free lead magnets in terms of these, shareholder letters and in terms of the level of detail that he goes in to help an average investor understand his psychology and what?
Yeah, he was the largest shareholder, so I think he had freedom where a lot of these annual reports, they're guarded, they're trying to protect, where he was just so brutally honest with his blunders, like you get to learn from, he talked about his mistakes so much that you get to learn about all of the big mistakes that he made as an investor. And sometimes those are buying assets that he regrets, talks about the characteristics of that, what he should have seen. You incorporate that into your own discipline. And then he talks about mistakes that he made not purchasing assets because he was too price sensitive, where he should have bought Walmart, and Charlie Munger and him got into an enormous fight about it, and they ended up not buying Walmart because Walmart's price earnings ratio was a little higher than his comfort zone. And it's one of the biggest mistakes that he's, if not the biggest mistake that any investor ever has made by not buying that. So that's the breath of fresh air with those letters, where you can just get education from the greatest capitalist, how he thinks. His brain works differently than 99.9% of human brains, and it has nothing to do with being smart. It has to do with, in my book, I write characteristics of successful portfolio managers, and a lot of that comes from Buffett and Charlie, because they really taught the world how to mentally behave as an investor.
I love that. I love that, Ryan. So when you think about investing, when you think about great personalities like Warren Buffett, what is your perspective on passive income? Do you feel like people can realistically live off of their investments, or is that just hype? Is that just a buzzword?
Sure, absolutely. And the ultimate passive income is a corporate bond ladder, that so as people advance and financially, they should be getting dividends or rent payments or interest payments from their assets. And that's the world that I live in. I do not live in the never non-cash flow producing asset. I sound like my daughter. But it's like I'll own a business that has a very bright future, that has sustainable competitive advantages, that I think we're going to make a lot of money on in the future. They do not necessarily have to be paying a dividend today. They don't even ever have, they just have to, I have to be able to look at them and say they're going to generate substantial cash flow in the future. So every business that we value on the future free cash flow that it's going to make, the cash that the owners of the business actually put in their pockets. But that dream is alive and well today for people. The real estate market has gone through like a shift with COVID. That has created pockets of opportunities. In my book, I write about autonomous driving. That's going to make the real estate market go through another major shift, in my opinion. Maybe the biggest shift we've ever seen with autonomous driving, where the commute isn't so unproductive and the commute isn't such a waste of time. If we have a commute that it can actually be enjoyable, people are going to want to commute more. So that has implications to the property market, definitely. And that we're in the first inning of that, seeing what these, I can't name company names, but the companies that are involved in self-driving, that technology is growing exponentially. So that's going to have huge implications. So, you have to, as an investor, the whole last 100 pages of my book is about the future. It's time ahead. We need to be, as an investor, you have to be able to have foresight. You have to look at the time ahead and be able to make decisions. So at a minimum, what you want to do is avoid companies that are going to be antiquated. It's important to, even if you don't, it's a lot easier to figure out what companies not to own than the companies that are going to win a very competitive race. I think a lot of value that I've added to portfolios over the years is avoiding companies that their business model has sunset and they've been about to be lapped by competitors.
Is it the
And those
business
type of
model or
business.
is it the ownership? Is it the leadership?
Pardon me?
Is it the business model in that situation, or is it the leadership, or is it maybe both?
Well, that's a good question. So it's both. Yeah, it can be both. You know, some leaders they're slow and they made strategic mistakes that disadvantage their shareholders. We have the most vibrant venture capital market in the world, and companies are emerging that are very competitive that were not even in business quarters ago. So um, it's both. I think it's the nature. It's the nature of it. Um, but we just want to make sure that we own businesses that we can uh, have a idea about how much free cash flow they're going to make 5 or 10, 15 years from now. Where that analytical confidence comes from is from sustainable competitive advantages. So, we own companies that, without naming names, but like certain software companies, it's very difficult to leave their platform and go to a competitor. It's a very high switch cost to exit it. Well, then we would have a pretty high amount of confidence on their customer retention ratio and being able to make forecast that we think is pretty accurate, as opposed to a business that their results are going to be quite binary. A biotechnology company, for example, that their profitability hinges on a clinical trial, things like that. That's people can do that very well, but that's not really what we do. You have to take a very different portfolio approach to that type of industry to owning high quality companies at fair prices approach.
I love that, Ryan. I couldn't agree more. So Ryan, you alluded to your daughter. If you were talking to the youth, whether it's your daughter or mentoring people, what money principle would you teach that person to help them sow the foundation for financial security and ideally financial
Yeah.
freedom?
Well, my daughter wouldn't listen to me. So let's do a hypothetical on somebody else's daughter, because,
My daughter,
yeah, yeah.
my daughter, she's 5 years old.
You got a
Hit me.
5-year-old. Yeah. So, yeah, I got 9, 11, 13. So, they
I'll
get
keep you in my prayers.
pretty smart. So, what I did on Take Your Kids to Work Day is I took them and we got Zillow out and we started a real estate company, and we
Interesting.
went and we did an analysis of all of the houses that were for sale in our community, and then we looked at the rent that we could charge for those houses, and we kind of like created a fictional business. And then I really took the time so they could understand how the banking system works. And, at a very young age, I understood how the banking system worked. And I think that having that knowledge as a young investor helps out tremendously, meaning that there's good leverage and there's horrible leverage for consumers. People that preach no leverage, you're really reducing that person's upside. And people that over leverage and they pay too high of a price for interest, the cost of money, those system work. This is what a checking account is. This is what a credit card is. This is the interest that you get on a checking account. This is the interest that you pay on a credit card. And, well, we would never want to do that. It's so illogical. And just to kind of like get those early lessons in life and then have them understand that, the best investment that the majority of people ever make in their life is their home, and having a goal to get that down payment so you could have that house, and then you could start using that bank leverage, meaning that you own an asset that's worth one number, but you only have to own 20% of it. So any upside you get on the full appreciation of the property, but you actually only own 20%. So if you have I just do this for your listeners. I know you know this, but if you have $1 million piece of property and you put $200,000 down and you borrow 800,000, well, if you make 50% on that property, you make $500,000, a $200,000 investment. So that leverage, meaning that loan that you took from the bank, that really allows you to get ahead in life. And that's one of the miracles of our country. And that's the sad part that I hear with the younger generation saying that housing is unaffordable and things like that. And I would encourage them to go someplace where the housing is affordable, especially with the ability to work in different industries, work remotely, just getting that, getting that started. You buy $100,000 house, you got to have to come out $20,000 out of pocket to buy it. Well, that $100,000 house, once it becomes a $150,000 house, you just made $50,000 on a $20,000 investment. That's the American dream.
I agree with you, Ryan. It's very powerful, and I want to kind of touch back to something you said at the beginning about like work-life balance and how it's like fictitious and maybe I'm putting words in your mouth, but maybe like a bit ridiculous, and maybe you shouldn't prioritize that. But I think you also got to a point where you could allocate time to the things that matter. Kudos to you for being an active father figure and actively like mentoring your child, because I haven't heard of an example like this to really break it down and say, hey, like, life is a game. This is how you play the game. These are the rules. And we're going to break it down step by step at a 5th grade level so you can kind of understand how banking, for example, and fractional banking and the banking reserve and how all of this works. So then you can understand the rules that you don't learn in school. And you can understand, how to, quote unquote, win at the game of life. So Ryan, I've loved the conversation. Obviously it went, well over time. So Ryan, if the listener is listening to this and they wanted to learn more about what you do, they wanted to connect with you directly, how can they do that? They don't want to have the same experience you had where you're writing letters to the author of the book and people aren't getting back to you. What is the most efficient way for people to contact you?
You can Google me, or you can hit me up on LinkedIn, and we're always open to having conversations with interested people.
Beautiful. So what I'll do is I'll include those links in the show notes. Once again, Ryan, appreciate your conversation. Appreciate you coming on to the podcast. You've reminded us that wealth isn't built by just luck or just timing. It's built by discipline, patience, and purpose. You don't have to predict the future to prosper. You just have to prepare for it. Throughout this episode, we've shared a lot of content that is solely educational. If this episode has opened your eyes, consider sharing it with somebody who's trying to build their financial future the right way. Hit subscribe, not for the algorithm, but for yourself. Because each week we bring you conversations like this that help you make smarter moves with your money and help you grow your mindset. Remember, you weren't born just to make a living. You were born to design a life worth living. Keep moving forward on your financial journey. Thanks, guys.